Hi, I'm Daniel Cooper from PCE, and today we'll be talking about the top 3 people who'll look at your projections. Number 1, we'll talk about the banker. The banker who provides credit to your company is going to be really curious about your forecast, most importantly, because it will tell him or her how much cash flow you'll be generating in the next 12 months, which will then effectively set your credit limit. It will allow the bank to provide you finance that you can pay back on time. If a bank is just going to provide you with a line of credit that expires next year, perhaps you'll just give them a budget for 12 months. Conversely, if you're going for something longer term, the banker will want to see the cash flow that allows that entire loan to be repaid. For instance, a 10-year term loan, the banker might want to see forecasts going out until 2034 in order to get comfortable with the fact that your business can repay what it's borrowing. So an appraiser would be curious about your forecast perhaps for several years. One of the approaches that business valuators use to establish what a company's worth is called a discounted cash flow. And that will look at 5 years of forecasts typically, and beyond that, to determine what your revenue will be, what your expenses will be, ultimately, what the cash flow is going to be. That cash flow and the risk associated with it will drive what your company's worth. Therefore, your appraiser is really going to need those projections. So the third category of individuals who are curious about your projections is potential investors. This might not be every year, but an early stage company that is not yet profitable may need to go out and convince people to buy in on equity of the business so that it can invest in software or technology that will allow it to become profitable in the future. So why does an investor need those projections, and why would they want them as part of their analysis? Any investor is curious about what rate of return they are going to get on the money they're putting in. And part of the process an investor will go through will be similar to the appraiser in that they will value the company today based on its future cash flows. And they'll also look 5 years into the future. If the company does hit its projections, what could it potentially be sold for? And then given the amount the investor is buying, say 10% of the company, what would that investor's stake in the company be worth in 2028 or 2029? An investor will then run its screening and make sure that that potential return 5 years from now is sufficient to justify the investment, which is obviously pretty risky. The preparation of forecasts is one of management's most important responsibilities. As we've discussed, there are 3 sets of external parties who will be curious to look at those forecasts when they're ready. They approach them in slightly different ways, but all of them will demand that the forecasts are accurate and prepared based on the latest available information. If you're curious about how to build out a 13-week cash flow, click on the link below. And of course, don't forget to like and subscribe.